Welcome all finance enthusiasts. Thank you for your interest in this series of the Securities Industry Essentials, SIE, exam. Why take the SIE exam? A person who is interested in the possibility of beginning a career in the securities industry will first need to pass the Securities Industry Essentials, SIE, examination. However, many of these successful candidates will subsequently take jobs with broker-dealers or investment advisors, which will require that they become registered as representatives of the firms. Once the SIE is completed, the candidate must take an additional exam, such as the Series 6, Series 7, or Series 79. Each representative will be assigned to a supervising principal who is responsible and liable for the representative's actions. The SIE exam is an excellent way to begin your career in the financial investment sector. It encompasses the fundamentals of the industry and prepares you for more advanced examinations. We provide a unique series of resources to help you excel in the SIE exam. Don't miss this opportunity to advance in the financial market. Subscribe now and join us on this exciting journey, and while you're at it, please like the video too. Thank you. We aim to provide you with invaluable content that meets your needs. Now, let us continue preparing you to pass the Securities Industry Essentials, SIE exam. Let's begin with an overview of financial regulation. Passing the Securities Industry Essentials, SIE examination will be the first step to achieving a career in the financial services industry. As we will explain today, financial services firms and their employees are subject to a significant number of federal, state, and industry regulations. We will provide a broad overview of the securities industry's multi-layered regulatory structure. Regulation. There are 4 tiers of regulation: federal laws, state laws, self-regulatory organization, SRO, rules and regulations, and firm-specific in-house policies and procedures. Each of these levels of regulation influences the activities of everyone who operates in the securities industry. Federal regulation. For broker-dealers, all capital raising, sales, trading, and operational activities are subject to stringent regulation. The primary regulation derives from laws, also known as acts, enacted by Congress. These acts are enforced by the U.S. Securities and Exchange Commission, SEC, which is a part of the U.S. federal government. The SEC. The Securities and Exchange Commission is an independent federal government agency responsible for protecting investors, maintaining fair and orderly securities trading markets, and facilitating capital formation in the primary market. The SEC is also tasked with ensuring that Congress's demands are implemented. Authority of the SEC. The SEC has jurisdiction over securities transactions executed on an interstate basis across state borders. The SEC may investigate potential securities law violations through its Division of Enforcement, which prosecutes cases on behalf of the Commission. The SEC may also initiate civil actions. If criminal activity is discovered by the Commission, the case falls under the jurisdiction of the Department of Justice, DOJ. Other federal regulators. In addition to the SEC, other divisions of the federal government are involved in the securities markets. These include the Department of the Treasury and the IRS, both of which are responsible for identifying and investigating illegal activities within the financial markets, such as money laundering. In fact, the IRS also provides guidance to investors concerning the tax implications of holding, buying, and selling various types of securities. The Federal Reserve Board, FRB, or the Fed, is an independent agency of the federal government that functions as the U.S. central bank. The Fed's Board of Governors, also referred to as the FRB, is responsible for controlling the nation's monetary policy, including the money supply and interest rates. The FRB's mandate is to create conditions that result in maximum employment and stable prices. To achieve this, the FRB controls or sets the discount rate, reserve requirements, and margin requirements on securities purchases. To influence the rate that member banks charge each other on overnight loans, known as the Fed funds rate, the Fed buys and sells securities. We will discuss these FRB tools later in the series. The Federal Deposit Insurance Corporation, FDIC, is an independent agency created by Congress. The FDIC's role is to maintain stability and public confidence in the nation's financial system. The FDIC ensures banking deposits and examines financial institutions for both safety and soundness to protect the nation's financial system. The current FDIC insurance coverage limit is $250,000 per depositor, per FDIC-insured bank. SRO regulation. Although the SEC oversees overall regulation, self-regulatory organizations, SROs, often handle the creation and enforcement of day-to-day rules that brokerage firms must follow. These include the Financial Industry Regulatory Authority, FINRA, the Municipal Securities Rulemaking Board, MSRB, and the Chicago Board Options Exchange, CBOE. The primary purpose of these self-policing organizations is to promote fair and equitable trading practices. SRO rules require firms to exercise reasonable due diligence when dealing with customers. However, because SROs are not part of the U.S. government, they lack the authority to arrest or imprison individuals who violate their rules. Financial service firms like broker-dealers are required to join an SRO and are designated as member firms. The employees of these member firms are referred to as associated persons. State, blue sky regulation. Each state has the authority to impose additional requirements on issuers, broker-dealers, their agents, known as registered representatives, and investment advisors with their representatives. Typically, a state mandates that both broker-dealers and their agents register in the state to transact business there. Additionally, issuers are generally required to register their securities before offering them for sale in a specific state. These rules, established under the Uniform Securities Act, USA, are referred to as blue sky laws, a term originating from a state court decision in the early 1900s. North American Securities Administrators Association, NASA. The provisions of the Uniform Securities Act, USA, are set by the North American Securities Administrators Association and enforced by individual states. States typically enhance their securities regulations by imposing stricter rules than those outlined in the USA. Each state has its own securities regulations department, led by an administrator or commissioner. NASA is the oldest international investor protection organization, focusing on safeguarding investors against fraud. Its membership comprises administrators from the 50 states, the District of Columbia, the U.S. Virgin Islands, Puerto Rico, Canada, and Mexico. Firm in-house rules. Member firms must establish and maintain a system for supervising their personnel's activities. Firms are required to clearly outline their policies and procedures by creating internal written supervisory procedures, WSP. A firm's WSP serves as a manual detailing the rules and identifying the individual or individuals responsible for enforcement. Within a firm, there are three categories of personnel: registered principals, registered representatives, RRs, and unregistered employees. The registered individuals who manage and supervise RRs are known as principals. Unregistered employees typically include administrative personnel, technology staff, or other support roles.